The fog of Brexit is causing short-term volatility in the economic data, and more fundamentally, it's creating a series of tensions in the economy. Tensions for business. Although many companies are stepping up their contingency planning, the economy as a whole is still not yet prepared for a no-deal, no-transition exit. As just one example, half the businesses in the latest survey by the bank's agents are not ready for such a possibility, and on balance, respondents expect output, employment, and investment to contract substantially if it were to occur. Actual business investment is likely to have fallen 3% over the past year, despite the ongoing domestic expansion, strong corporate balance sheets, and high business profitability. The latest indicators, including from the bank's decision-maker panel of over 7,000 firms, suggest more of the same. There's increasing evidence that companies are also building stocks as part of their contingency planning. It's likely that these have a strong import component, thereby limiting the net impact on aggregate demand. But the news is not all glum. Even though companies aren't currently investing, they are hiring, with the employment rate now the highest since records began in 1971. The fog of Brexit is creating tensions for households. Despite that strong labor market, consumer confidence took another step down in January, and the gap between the relatively high confidence that households have in their personal financial situation and their more skeptical view of the general economic outlook is now extraordinarily wide. It's possible that such uncertainty is holding back spending on durables, including cars and housing. Indeed, with house prices now flat nationwide and mortgage demand soft, spending on all aspects of housing, including renovations and transactions, could be a short-term drag on growth. Retail sales contracted by 0.2% in Q4, and indicators suggest spending growth has been modest since the start of the year. Nonetheless, given the historic resilience of the UK consumer and the strong growth in household real incomes, which are likely to have risen by 2.5% in the year to 2019 Q1, and that's the strongest rate since the referendum, household spending is an upside risk to our forecast. And finally, the fog of Brexit is creating tensions in financial markets. Those markets remain sensitive to Brexit-related news, and a variety of risk premia on UK assets are elevated. Given the wide range of potential scenarios and the various paths to them, it would be remarkable if the current levels of sterling and other UK financial asset prices were consistent with the outcome that finally emerges. Now, how these tensions are reconciled once the fog lifts will have consequences for the path of monetary policy in ways that cannot be predicted in advance. And to forecast the economy and set monetary policy accordingly, the MPC must make a series of judgments and assumptions. And first, on the judgments, given the dynamics of the negotiations, we are now assuming uncertainty remains elevated for a while and that financial conditions stay tighter for longer. Second, we have downgraded our forecast for UK-weighted global GDP, so the bit of global growth that matters for UK exporters, by 0.5%, and that's material. Over the past year, the global economy has transitioned from robust, broad-based expansion to a widespread slowdown, with all major regions currently decelerating in the wake of tighter financial conditions and rising trade tensions. Nevertheless, with the easier paths of monetary policy in all major economic areas now implied by markets, the MPC expects global growth will stabilize later this year at around potential rates.